Welcome to The Explainer. Think about the biggest check you write all year. Yep, your tax bill. What if that could actually be the key to building wealth faster than you ever thought possible? Today, we're deconstructing a powerful real estate strategy that flips the tax code on its head, turning it from a burden into a blueprint for your financial freedom. So the whole idea here is a total mindset shift. Most of us just see taxes as a financial drain, right? A necessary evil. But what if we've been looking at it all wrong? This strategy treats the tax code like a set of instructions, showing you how to literally turn that liability into a powerful engine for building your portfolio. Let's dig in. So to really get how this works, we first have to talk about the problem it's built to solve. It's kind of this structural thing in the tax code that trips up a lot of folks who make a good living. All right, so picture your financial life, right? The tax code basically splits it into two different buckets. In one bucket, you've got your active income. That's your salary, the money you work for day in and day out. In the other bucket, you've got passive income, money your assets make for you, like rent from a property. The catch? These two buckets are totally walled off from each other. And here is the wall I'm talking about. A rule from way back in 1986 created this separation. It says that even if your real estate is kicking off these big paper losses, and we're going to get to what that means in a sec, you can't use them to lower the tax on your main salary. And that, right there, is the problem we need to blow a hole through. So why real estate? Why is this the go-to? Well, it's because it's this unique wealth-building engine with three core parts all working at once. There's a reason experts consistently point to it as one of the most tax-advantaged investments you can make. Just one property builds wealth in three ways, all at the same time. You get appreciation as the value, hopefully, goes up. Your mortgage gets paid down by your tenants. And then you have the real superstar for our strategy today, depreciation. It's a massive tax benefit. Okay, so depreciation. You absolutely have to get this part. It's what we call a paper loss. The government lets you deduct a slice of your building's value every single year for, wear and tear. But here's the crazy part. You're doing this even while the property is probably going up in value. So it's this huge tax deduction you get without spending a single dime of actual cash. It's like a phantom expense. Okay, here we go. This is the turning point. We've got the problem, that wall, right? We've got the engine, those juicy real estate paper losses. So now we just need the key to connect the two. And it turns out there's a very specific strategy that lets us break right through that wall. And this is the key, the short-term rental strategy. See, by running your property like an Airbnb and hitting certain rules, the IRS actually reclassifies it. It's not a sleepy, passive investment anymore. Nope. Now, it's treated as an active business, just like a hotel. Now, to unlock this whole thing, there are two main criteria you gotta meet. First, the average stay for your guests has to be 7 days or less. Second, you have to materially participate. Sounds complicated, but it basically means you're spending at least 100 hours a year managing the place. And you're spending more time on it than anyone else you might hire, like your property manager or your cleaner. You've got to be hands-on. And boom, just like that, the wall comes tumbling down. Those massive depreciation losses we were just talking about, they can now flow right from your passive bucket straight into your active bucket. And what does that mean? It means they directly slash the taxes you owe on your main job's income. All right, so we've connected the engine to your income. But why stop there? Let's talk about how to supercharge this thing for the biggest possible impact, like right away. We want to make those paper losses absolutely massive in year one. Okay, let's throw some numbers out here to make it real. Say you've got a $1.2 million building. With standard straight-line depreciation, you get to write off the value over 27 and a half years. That gives you a nice, solid deduction of about, $43,000 a year? It's good, but we can do so much better. The tool we use to do this, it's called a cost segregation study. Now, instead of just lumping the building together as one big thing that wears out slowly, this strategy is all about breaking it down.
It identifies all the pieces that wear out way faster. We're talking carpets, appliances, light fixtures, that kind of stuff. So a cost seg study might come back and say, hey, look, 25% or more of your property's value is actually tied up in these short life components. And the tax code says you can write those things off over just 5, 7, or 15 years, not the full 27 and a half. See where this is going? So what does this actually mean for your wallet? It means you get to front load all that depreciation. Your first year deduction just explodes. For example, if that study shifts just 300 grand of the property's value from that long-term bucket to a short-term 5-year bucket, you get an extra $60,000 deduction in year 1 alone. That's how that initial 43 grand can easily skyrocket to over 120 grand. That is a massive paper loss you can now use to wipe out a huge chunk of your tax bill. Okay, let's put it all together now. We've got this short-term rental thing creating a giant tax refund. So the next question is obvious. What do you do with all that cash? This is where the whole thing becomes a repeatable, scalable system for building a real portfolio. A really popular way to think about this is the BRRRR method. It's just a smart, systematic way to buy properties that need a little love, force their value up with renovations, and then pull your original cash back out to do it all over again. The cycle is pretty simple, but it's incredibly powerful. You buy a place that needs work. You rehab it to push the value way up. You rent it out to get that cash flow going, and then here's the magic step. You refinance based on that new higher value. This pulls your original investment right back out. And finally, you repeat the whole process with the same capital, which is now ready for the next deal. And here it is. This is where the two strategies just click together perfectly. That massive tax refund you get from property number 1, thanks to the short-term rental hack and the cost segregation, that becomes the down payment for property number 2. You're creating this incredible, powerful loop, legally using tax savings from one property to go out and buy the next one. So it really makes you ask the question, right? Is the tax code this big, scary burden, or is it actually a blueprint for building wealth? What this all shows is that the code isn't just a list of rules for paying the government. For the people who really take the time to understand it, it's actually a set of incentives. And when you align your investments with those incentives, you can literally transform what is most people's biggest expense into your single greatest strategic advantage.